Well, hello everyone. Welcome to Getting Started with Options. Today we are going to talk about long calls. So this is a bullish strategy, and it's a great time to be talking about this strategy because the markets have been very bullish. You know, they've had their ups and downs this year, but they've been kind of bullish all year long. When we look at the long-term trend, and this is a strategy that some traders might use in order to take advantage of a longer term move in a stock or a shorter term move in a stock. So it's called a long call, and I'm looking forward to talking about this as strategy with you today. Now, there are always risks involved in trading options, and we'll discuss what those risks might be also. But before we get into all of that, let me just invite you to join me in the land of Twitter, now known as X, my handle at Barb Armstrong CS. It's another free resource that you can take advantage of, and I hope you'll choose to do so. I also had the privilege of having Cameron May riding shotgun in the chat. He's going to answer any questions that you throw our way that he can answer, without needing, for you to have a visual on a chart kind of thing, as long as they're pertinent to our topic for today. And he's a friend and fellow coach. So you're going to want to follow Cameron as well. His handle, Cameron May CS. So, and it's great to have so many of you here with us live and participating in the chat. So hello to Mike and Delgado and Kevin and Tony and Sharon and Bob and Josh and Bill and Frank and Jay and Lamont and the rest of the gang. It's good to see some new people here and, along with, as I affectionately call them, our usual suspects. So welcome to everyone. And if you're new, know that we link arms here live every Tuesday at high noon, and we are figuring this stuff out together. Feel free to type a greeting into the chat so that we can welcome you. Know that options carry a high level of risk and aren't suitable for all investors. When we buy a call, which is what a long call is, we could lose 100% of the money that we put down to open that trade. So it's important that we understand what the risks are and that we plan for risk. We use the Paper Money software application on the Thinkorswim desktop platform. This is a brilliant place to be able to practice. Not only can you learn then how the Thinkorswim platform works, but make sure that you understand the strategy you're trading before you consider trading it in your live account. There are some nuances and differences between a Paper Money and a live account, and we'll discuss those as we go. But know that we're going to place a couple of trades today as examples, but that, every stock that we look at is for example purposes only, not to be construed as a recommendation. Okay. So, I designed this to be taught in a 12-week rotation. As many of you know, I'm a product of this education, and I created the Learning to Trade Options series that I wish had existed when I first started. And we are back at the top of the rotation. So today we're talking about long calls. And as we go through this 12-week rotation, we'll discuss 10 different trading strategies. And some of them, like a long call, you can trade a long call multiple different ways. So we'll look at one or two of those ways today. And if you're brand new to options, I do my very best to speak in English throughout the entire thing, but there is a language around trading. So if I use a term that you don't understand, please type something into the chat, and I'm sure we can get you a quick answer. Long means buy. So we're looking at buying a call today to open a trade. Okay, so, and what we're going to cover is the basics of what it means to buy a call. We're going to look at why some traders might choose to use this strategy. And, we're going to look at some things that you want to take into account when you're trading a long call. And then we're going to place a couple of example trades. So what does it mean to buy a call? What am I getting myself into when I buy a call? Well, buying a call gives us the right, and I'm just bringing out my drawing tool here. It gives us the right, but it doesn't make us obligated. So we can kind of use this if we want, but we're not committing ourselves. So we have the right to buy the stock at the strike price at any time up until the expiration. And one option represents 100 shares. So we're effectively getting the benefits of the movement of 100 shares of stock without having to make the financial investment to buy 100 shares of stock. So it's a more affordable way to trade. But, you know, as with anything in life, there are trade-offs. So when might we use this strategy of buying a call? Well, when we're bullish. In other words, when we're looking at a stock and we're thinking it might continue to go up in price. And especially if we think that it may move upward quickly, we might want to buy a call. And, you know, one of the things that's really appealing about buying calls for some traders is that the reward is potentially unlimited. You could make a 100, 200, 300, 500% return potentially. But what's the flip side to that? You know, because when we look at that and you think like, well, this is fantastic. Like, why have people been telling me that options are risky and I shouldn't consider it? Well, this thing could also expire worthless, which means we could lose 100%. You know, we could, and brackets means you've lost. So we could lose the entire amount. Okay. So, you know, when we look at this and we say, okay, so I'm a visual person and I'm assuming there's at least one other visual person out there. So we have a stock that's been going up and then maybe it pulls back for a few days and then it starts to go up again. And then it pulls back for a couple of days and then it starts to go up again and you're going, aha, I think this is an uptrend. I think this stock is going to continue to go up. So what I am going to do is bring my drawing tool over. Just one sec here. Let me put it over here so it's easier for me to get to. And let me change this color. So we're going to buy a call right here at the money. Now you can buy calls out of the money and we can get into that conversation later. There is a class just dedicated to, you know, buying calls and buying puts, just by the way. So if we buy a call at say $50 because we think the stock is going to go up and we're right and it does continue to go up, let's say it goes up to $60. Okay. Now, when I bought this call, let's say I paid $2 for it. Now it's gone up to $60. Now, what does it mean when I buy a call again? Well, I have the right to buy the stock at the strike. So this gives me the right to buy the stock at 50. So I could exercise my right to buy 100 shares of this stock at 50 and turn around and sell it at 60. And that's one of the ways that I can profit by buying the call, right? Is doing that. And then if I did that, how much would I make? I would make $1,000 because I'm making $10 a share, right? Minus the 200 that I paid to get into the trade. So I'd be up $800. Now you may be saying like, hey, Barb, this sounds really great. And in fact, it would be really great if this happened. But I don't want to have to exercise this option because I'm starting out small. I only have $3,000. So I don't have $5,000 kicking around in my account to buy the stock. Well, what some people will do is they'll say, I really have no intention of exercising my right. What I want to do is buy it for 2 and sell it for more. So, you know, how much would this be worth? Well, it's got to be worth at least 10 because there's that much value in it. And so if I just bought it for 2, sold it for 10, how much would I make? Well, I'd make $8 a share, you know, and then that's $8 a share times 100. So you'd make the same amount either way. And, you know, this is when people start thinking like, Where have options been all my life? This is absolutely fantastic. You know, we're popping champagne, people are dancing in the streets. You know, but you know, what's the downside? Well, if in fact we are not correct, and there are going to be times when we are not correct, if it goes down in value, it's going to become worth less. And like, you know, let's just say it goes down to 40. Well, I now have the right to buy it at 50. If it's, but who would want to, you know, buy this from me and pay me $2 when they can go out in the open market and buy it for 40? You're going to go, yeah, no, you can keep your call, and it's going to become worth less and ultimately worth nothing. And so, while you're saying like, this is fantastic, here's a 400% return. Well, you know, you've got to realize this could also be 100% loss. So, you know, and really your potential gain, it's not limited to 400%, it's unlimited, because who knows how high it could go. Yeah. Yeah. And you know, while you're saying, well, wow, if I bought the stock and it's trading at $50 a share, that would cost me $5,000. Instead, I can buy this option for 200 and you know, experience the same benefits. But one of the benefits you don't experience is dividends. And another thing is that this has a deadline on it. You know, like, let's say you buy the December 20th option. If this stock hasn't moved by December 20th, you may be right in the long term, but wrong in the short term. Then, you know, this expires worthless. Where, you know, if something's going sideways, and at the end of a couple of, you know, your expiration period, it's still trading at the same price, the long option, you know, your long call, that call that you bought would be worth pretty much nothing. Your stock is worth the same amount. You haven't lost a thing. Okay, so there's no free ride in anything, you know, so you have to look at the pros and the cons. And, you know, I've just outlined kind of what the pros and the cons can be with buying a call. Okay. Now, I don't usually show this, but you know, this is kind of a point of review, right? So if we come and we look at this and we say, okay, I'm just going to bring my drawing tool up again. Oops. I guess I needed to erase that. So here's our max gain. And we talked about that before. And what is it? Unlimited. You know, maybe there could be some buyout announced or some new product, or, you know, who knows what it is. And it also gives us leverage. So we can invest a small amount, in our example, that $200, and it could go up exponentially. You know, so, you know, and it's a lot less expensive than buying the stock outright. But there are caveats to that. And so a time frame, you know, often with this type of strategy, people might use it for a shorter or more intermediate term, days to weeks, as opposed to buying a stock and perhaps wanting to hold it for, you know, months to years. But our max loss can be that total amount paid. It can be 100%. And then when we look at time, time is not our friend. Time is working against us. You know, and so that can negatively impact our trade. And also with volatility, when volatility goes up, the price of the options tend to go up. So what we'd rather do is buy it when volatility is low and then have volatility go up. And then, you know, so it can negatively impact, it can also positively impact. But time decay, DK is DK. You know, every day that you're in the trade, it's chipping away as it approaches the expiration date. And as it gets within that last 3 weeks, it decays at an accelerated rate. And so when we're buying a call, we often say, well, if we think this is going to take, say, 5 to 10 days to reach a short-term target, we want to add another 3 weeks at least to the expiration date, so that time, the impact of time decay is a little less. And our break even is going to be the strike price, so our $50 plus the premium paid. So in our example, our break even on that imaginary trade on the imaginary stock would have been 52. And, we talked about, you don't capture dividends. And this is not a forever thing. It's more of a dating strategy than a marriage, right? Yeah. Okay. So I'm as many traders are, a big fan of having a plan. And, that's a trading plan. And so I have started to create a number of trading plans. And I have one in there for a long call. I'm going to add a second one this week. Okay. But part of the trading plan, and I'll show you where to access that. And this is just an example trading plan that we can use as a framework. But these trading plans, they tend to incorporate, I've reconfigured things lately, and I'm still getting the hang of this new setup. So we are looking for what to buy, when to buy, how much to buy, when to exit, and then what are our routines. So we're looking for those 4 or 5 basic components. And so this is kind of the what to buy piece of it. So we're looking to do a trade on stocks that are in an uptrend or a bullish trend. And some might also say, like, in addition to that, I want to see that if this is something in the tech sector, I want to see that the tech sector is uptrending. And I'd like to see that the market is uptrending so that you're going with the flow of the river. And others might say, hey, as long as the stock's uptrending, I'm good to go. But if you can come here and say, hey, the stock's uptrending, the market's uptrending, the sector's uptrending, check, check, check. And then they're looking for stocks that have high trading volumes. And, what do you mean by high trading volume? Well, you might say, I'd like it to trade 1 million shares per day or more. Now, I've seen James do queries, James Boyd, another coach, where, he wants it to be 5 million. I mean, you can make it whatever you want. Okay. And then the options, you want those to have higher trading volumes. Open interest is the number of contracts that were on the books when the market opened today. And volume is the number of contracts for that stock at that expiration date, at that strike, it's that specific, that have been traded today. And so we might say, well, we want that to be at least 20 times the number of contracts that we're trading. And why would we care about that? Well, because when it comes time to sell the call that we've bought, we'd like there to be a market for it. And, and some, traders might not even look at this. They might just say, well, I just want a tight bid-ask spread, the difference between the bid price and the ask price, to be less than 10%. And if it's less percent, if it meets that requirement, I'm just going to assume that this part is in place. And some just say, yeah, I'm not assuming. I'm not assuming anything. I'm going to check. So this could be our what to buy. And then this section here is our kind of when to buy. Well, we're looking for a stock that's uptrending, right? And so these aren't all of the patterns that might qualify for an entry, but something that's breaking above resistance. So if something's been going in a sideways pattern like this for a while, and then all of a sudden it breaks out, it might come back and retest and takes off. So this is resistance. If it breaks through a resistance level, that could be considered an entry. I was drawing what we call a bull flag. So, and often with a bull flag, we're looking for a close above the high of the low day. Sometimes with these sideways patterns, it could end up being something that looks like this, an inverted head and shoulders. Cameron May teaches a class actually later today on getting started with technical analysis. And so if it broke out here, we'd consider that, some might consider that to be a potential entry. So here's our what to buy and when to buy. And then the next two are how much to buy and when to exit. Okay, so we're making headway. But when we look at these first two pieces, I think it's helpful to then go out and let's come out to the Thinkorswim platform and have a look at a couple of examples. So the first example I wanted to bring up was Google. Now, Google has one of these, you know, and I just had drawn it on the chart. Let me bring my drawing tool back up. And I'm going to have to change the color so it'll show up. But do you see this inverted head and shoulders pattern? And so, you know, a technician might say, hey, this has moved about $20, so I'd expect it now to move up about $20. It's actually just over $20. So if you're saying, I'd expect this to go up to, you know, 189 or 190, move another $20 to the upside. Once it breaks out, but it broke out, it came back to retest, and then it came back up similar to this 182 level. And it seems like this is maybe some kind of new ceiling. And then it came back, so came back into the neighborhood, didn't come back quite as far, and it's moving to the upside again. So could we place a trade saying, hey, if this comes back up to 182, if we think this is a bullish stock, it's up 26% year to date. It's in the, you know, if you're not sure of which category it's in, some might say, oh, is this, you know, a tech stock? Is this in the communication sector? We can come over to the Analyze tab, and it's in communications. And so if you wanted to look at the sectors, you know, remember, is the market uptrending? Are the sectors uptrending? Well, here is the communication sector, and I'm linking this to my chart. Well, this sector hit a new all-time high in the last week or so, and, you know, it's up 33% year to date. So looking at that, some might say, okay, so the sector's uptrending. If we look at the S&P 500 in general, it's up 24% year to date. So if we wanted to say sector, stock, you know, and the market overall, check, check, check. So those are all uptrending. And then when we come and look at Google, do we have, you know, that when to enter the trade? We have that. So check. We pulled back. We had a close above the high of the low day yesterday. Does it trade more than 1 million shares a day? Well, we're still early in the trading day, and it's traded 10 million shares. And if we're thinking like, hey, the last time this pulled back, it took 3 days to pull back, you know, maybe it'll take, you know, it could take 5 or 6 or 8 or 10 days. Could we come out to December, and I have an awful lot of strikes here, we don't need that many, and buy a call either, you know, at this 175 level, that would cost us $585 to $595. And what were our questions on what to buy? Well, they were, does it trade 1 million shares a day or more? We've got to check on that. So, because we're at 10 million. Here's our open interest, number of contracts on the books. So 10,000, we're only going to do one. So as long as this number is bigger than 20, we've had 1,800 contracts traded just today. And then, so that's a check, check, check. Does it have a tight bid-ask spread? Is it less than 10%? So we're saying, is it less than 60 cents? It's 10 cents. So we're good to go on that. Okay. So check, check, check. Now in position sizing, we have a small account here with 41,000 and change in it. We don't want to risk more than say $500 to $600 on any one trade. And so if we say, well, then maybe instead of doing this 175 5 strike, maybe we can do this 177.50. And what's the difference? Well, the delta here is a little different. And what delta tells us is this is the amount, if the stock goes up by $1, that you'd expect the stock, the value of the option to go up by. So by spending less on the option, we're getting less benefit for each dollar of movement. But if we're okay with that because we don't want to break our position sizing rules, and we'd say, okay, this 177.50, it still has hundreds of contracts. We're good with that. So now with a swing trade, because we're just going to trade it up to the previous high, and our previous high was not all-time high. This previous high is like 182. So I'm going to come to our trade tab. We're going to right click anywhere on this line. We want to buy custom, and we're going to put in both a target and a stop. And so we're willing to pay the going price. We're going to make both of these good till canceled. With a swing trade, and we haven't, I will create a plan and put it online just as an example, and then you can modify it however you like. But we're going to say if this goes down by about 50%, we would like to take what remains of our premium and go home to trade another day. So we're going to put in an order to get out if the value of this option falls to 235 or below. So if it goes 50% below. And then we don't know quite what the option is going to be worth if and when it gets to the target that we want to put in, but we're going to click on this disappearing, reappearing sprocket. Okay. And it brings up a conditional order. And we're going to say, we would like to sell this, call on Google if and or when Google goes back above, when it gets back up to 182. We're going to hit save, confirm and send. Now we have both a target and an exit, so we know when we're getting out, both if the trade goes for us or against us. Our risk rules say we don't want to risk more than 500. And so some might say, well, why aren't you doing 2 contracts? And so for some traders, they might do 2 contracts. Because, if you're saying I'm going to get out if I'm down 50%, then if you're down 50% and you get out at 235 and you've done 2 contracts, then you're still risking under 500. But a more conservative approach might be someone saying, well, just in case something happens that isn't expected, it's not a guarantee I'm going to get out and get my 235. I could lose more. And so I'm just going to do 1 contract for that reason. And then we're going to put this, we're going to read this out loud. We want to buy a call on Google because we're bullish, right? Right. Our expiration date is in December, about 30 days out. We want to exit this when Google goes at or above 182. So, and it's currently at 176.88. Or if this option loses half its value, we'd like to exit. How much could we lose? $470. You see, this doesn't pay attention to the fact that we're saying we want to get out if we lose that amount. Technically, we could lose all of this. And how much can we make? Well, it's unlimited. We're going to put this in our long call group on the monitor tab. And then we are going to make a note here, and this is just from us to us, that it's a swing trade. This is a swing trade target. And we could even come out and put this on the chart, click that line and say our target, this is our swing target. And then when you're checking your trades, now, remember I said there were, kind of 5 components: what to buy, when to buy, how much to buy, and when to exit. The last one is, what is your routine? So the routine is this. You're going to look at this every day. And if it gets really close to the 182, like I've seen it get within a nickel of my target. And then it sets up a candle pattern that is saying, okay, this uptrend may be drawing to a close for the time being. So if it gets to like 181.90, you might say, you know what, that's close enough. I'm going to take the money and run. So you're going to be looking for that. The other guideline you may have on a swing target is we're expecting this to move up in, it's say 5 days or less. So if in 3 days it hasn't gone kind of halfway to the target, we may say, yeah, it's not moving fast enough. I'm going to take what I've made and call it a day. And the other kind of mid-management trade guideline that some traders might have, they might say, hey, if this goes down 2 days in a row, this is a short-term trade, not going in the direction I'm expecting, so I'm going to exit the trade. And so because time decay, if it just starts lollygagging about and going sideways, it can really eat our lunch, can't it? Yeah, so somebody's saying, how do you initially set up the groups? And you know what? I can show you that. So we can come to the monitor tab and we can come out here. And do you see where it says here, position statement? I can come over to this position statement and say, I would like to add a group. And then it brings up this little thing, and I'm going to say test group. And then it will add a new group. And sometimes it goes to the very top. So here's our new group. And then you can customize it however you like. So like I've added here, I like to see the profit and loss. If it's a stock position, I like to be able to see what it's worth if we sell it. What it would put back in the account. But you can, you can bring all of that up. So here's our long call. We have one on GoDaddy that we placed in a class yesterday, and that's up 30%. And then if you want to see the note that you put in, and on this one, I didn't put a note, but this is another swing trade. And so I could add a note to this swing trade, save. So this was one that we did yesterday. And the target is 190. And if you're wondering, like you want to be able to see a target, we can come back here and we've got our trading on Google hasn't filled yet. I know that because it has both a buy and a sell. So if you're saying, well, why hasn't that filled? Well, now they want a little more money for it. Now they want 480 and it went in at 470. So we can just cancel and replace and say, okay, if you need another 10, 15 cents, we're okay with that. And then we're going to put our swing target in here again so that we remember what set of rules we are trading by. Marcia, I don't remember how I made it different colors. I'll post something on X later today on that. Cameron, do you remember how to make the profit and loss different colors? It was Kevin Horner that told me about that. I'll figure it out and I'll post it. Okay. You want to do another example? I mean, there's probably lots of examples out there, right? And I'll post a couple of charts today on X, just examples of things that are bouncing or breaking out. But here's Apple. And Apple is, it's been, you hate to call it a laggard because it is up 20%, 19.4% year to date. It's in the tech sector. So again, is the overall market uptrending? Well, we already looked at that. So that's a yes. If we come and we look at the tech sector, has the tech sector been uptrending? Yes, it's up 32% year to date. This is a 6-month chart. So if we come out to a 1-year chart, like look at that. It's quite extraordinary. So you could say, check on the markets, check on the technology sector. Then we come and we look at the chart for Apple. And it's been consolidating. Whoops. Apple's been consolidating, but it's come down to this support level and it's bouncing and moving up. So could we do another one of those kind of swing trades where we buy a call and say, hey, when it gets back up to 237, let's take the money and run and do a shorter term trade. So again, when you come to the trade tab and we look at this and say, you know, what were our categories, what to buy, when to buy, how much to buy, when to exit. So in our what to buy category, does it trade 1 million shares a day or more? Check. 14 million, check. If we look at December, which is 31 days out, and we look at this strike that is, you know, close to where it's currently trading, you know, again, this is interesting. The first strike in the money, it's just at the very top end of our snack bracket. You know, we don't really want to be much over 550, so maybe we do the 460 instead. Now, we could also do the 235, and then that's 350, and then we've got like 44,000 contracts as opposed to hundreds. But the bid-ask spread, and the bid-ask spread is 5 cents instead of 10 cents. You know, but then for each dollar of movement, we're seeing less benefit. But we're seeing less benefit, but on a, you know, a less expensive investment. So, you know, sometimes these work out nicely. So this would be considered an out of the money strike. And if we're doing that because that's what we can afford, you know, that's valid too. So let's go with that one. But we've got, you know, check, check, check. And then our target on this was $237. And with a swing trade, our exit, so we're coming out here to this one. We're going to buy, custom with an OCO bracket. So again, how much could we lose? This entire $345. We're going to make both of our exits good till canceled. We're going to take that 340 and divide it in two. So we're going to make that 170. If it gets to 170 or lower, we'd like to exit. And we're going to make this a market order. And then we're going to bring up our conditional order window to say, hey, if and when Apple goes at or above 182, we would like to take whatever profit we have and call it a day. So again, how much can we make? Unlimited. How much can we lose? $340. Why are we just doing one contract? Because we don't want to risk more than 500. And we're buying a call because we're bullish, right? We want to exit when it goes above 182. Oh, this is Apple. Sorry, this is supposed to be 237. That was the Google trade. This is why, this is why we review these. And that's why I review them in the way that I do. So I'm bringing this order back up because what would have happened is it would have immediately filled that order because it's trading above 182. So we want to make this 237. Yeah. Yeah, you guys caught it. You guys are on top of things more so than I am this morning, it would seem. Okay, save. And this is why, when we look at it, it's like, okay, the target is 237. Is that above 230? Yes. And you know what, guys? Like, I will say this stuff out loud when I'm placing trades in my live account to myself. It's kind of when you wish you had a dog, because then it could sound like you were talking to your dog. But, don't be in too much of a hurry, or you can make mistakes like this. Okay, it's costing our transaction fee. It's 65 cents to buy that contract. That's the transaction fee. We're putting it in our long call group, and we're making a note that this is a swing trade. Okay, so there's a couple of things that I'd like to show you. So one is, if you haven't subscribed to the channel yet, the Trader Talks from Schwab Coaching, you're going to want to do that. And one of the reasons why, like I had somebody type into the comments one time, I saw one of your classes 3 months ago, and then I couldn't remember your name. And it took me months to find your webcasts again. If you subscribe to the channel, you're not going to end up with that problem. So when you first get here, you're going to see whichever class is currently being taught or the next one up. If you come to playlists and you scroll down, there is a series called Trade Management Mini Sessions. And when you view the playlist, I put these in the order in which we're going to cover them. And remember, I said we have 10 trading strategies. I've just got 5 in here so far. And for long calls and long puts, there will be 2 of each. So there's one here, a long call with a 1 ATR target trading plan. I'm going to add one for long calls with swing targets as well. So look for that in the next week. And then if you're newer to Thinkorswim, and these are just example plans, so it's a framework from which you can customize, what you want to do. And then if you come down here, I've created a bunch of bite-size mini sessions on the Thinkorswim platform. So someone asked about customizing the monitor tab. Well, here's an 11-minute video on just how I've customized the one that we use for our classes. Or if you saw that watch list and thought, how did she get that description in there and those other things? There's one on customizing charts, watch lists, on using notes, you can customize your option chain, all that kind of stuff. And I'll add more as requests come up. The ones in the middle pertain mostly to my trading a smaller account class, and we're comparing 2 different strategies, or, we're doing a post-mortem on some example trades that we've placed. But that's something I just want you to be aware that resource is there. And then if you come down, and I don't know why they're at the very bottom, but both Cameron's Getting Started with Technical Analysis, if you're new to looking at charts, there's a whole playlist on that. And then Getting Started with Options, if you want to, instead of binging on Netflix, you could be binging on options, and I've labeled them, so we started at 1 and, it'll go to 12, and then we'll start it back again. Okay. So you want to hit that subscribe button. If you hit like, it's a chance for you to do a favor for a random stranger, without leaving your desk, because you're moving this up in the algorithms on YouTube, and we appreciate you helping us with that. But like Cameron said, it sounds like applause to us, so it lets us know that you found this content valuable. So subscribe, hit the like button, and then don't forget to follow us in the land of X. Cameron May CS and Barb Armstrong CS. We'd love to see you over there. I'll be posting a bunch of things this afternoon, and it's just another way for us to be able to communicate with you outside of webcasts like this. So, and when, remember what to buy, when to buy, how much, and exiting when it's a profitable trade, when it hits the target, and it could be this 1 ATR target that we didn't talk about today, or a swing target being a previous high. If it's not profitable, with an ATR trade, we have a different exit, but it might be a percentage. Some might say, I'm willing to lose all of it. I'm not going to put in that 50% loss order. With our example trading plan on the swing trade, we said, we're going to make it 50%. You can make it whatever you want. And then you may want to take into account earnings, and other corporate news when you're placing these types of trades. Okay. And then for the swing trade, I threw in a couple of maybe mid-management rules that some might want to consider. And, although we're looking for bullish or stocks that are uptrending, it could be breaking out of a sideways pattern. We talked about that. We looked at both strikes that were at the money and strikes that were in the money. And then we chose, for our second example, one that was out of the money, and that was a price-related decision. And know that, time is money. Time is money in the world of options too. The more time we buy, the further out the expiration date, the more time the option has to move, the stock has to move, but the more expensive the option will be. And position sizing, that's an important part of our recipe, right? And some will position size based on max loss, and others will make different decisions. So we've covered long calls. We've done 2 examples. We did one on Apple, we did one on Google. Yeah, and we'll make sure those fill. So guys, have an awesome day. Keep coming back. Up next, Trading Flag Patterns with Ben Watson. Bye for now.